A rate conundrum, the German bond market's uncertain future. Despite the European Central Bank's ECB expected hold on rate cuts, there's a compelling case for a potential dip in German two-year bond yields. Let's dive into this intriguing scenario and explore the factors at play. While the market and experts agree that an ECB rate cut is unlikely, we're taking a closer look at the short-term German bond market, specifically the Schatz curve. Even with the hawkish tone from the ECB's governing council and resilient economic data, the market is not anticipating any immediate policy changes. However, a rate cut is still on the cards for next year, with a probability of one more cut priced in for June 2026. This cautious approach is reflected in the current German two-year Schatz yield of 1.95%. But here's where it gets controversial. We believe the market is being overly optimistic about the downside risks. The potential for the Fed to accelerate rate cuts and its impact on the exchange rate, coupled with the ongoing trade tensions between the US and EU, could create a perfect storm. Add to that the political instability in France, and you have a recipe for market volatility that the ECB might want to avoid exacerbating. So, what does this mean for the German two-year Schatz yield? Well, with the yield sitting close to 2%, we see several reasons why it could head south. For one, the Schatz yield is currently at the higher end of its range this year, trading at a premium of 10 BP above the risk-free ESTR overnight index rate. This suggests that the market is pricing in a relatively low probability of default, which may not hold true in the current geopolitical climate. And this is the part most people miss. The US 10-year yield is inching closer to a break below 4%, even if it's a fleeting moment. Recent economic data from the U.S., including jobs revisions and core PPI figures, has provided an excellent opportunity for the 10-year yield to dip below 4%. A successful 10-year auction further validates this move, taking the yield to sub 4.1%. While we anticipate a potential attack on the 4% level for the 10-year yield, we also believe any such move could be an overshoot. Our view is that the neutral range for the 10-year yield is between 4.25% and 4.5%. Given the current inflation environment, which still shows signs of upward pressure, we could see a trend back towards this neutral range, especially with the fiscal deficit remaining elevated. Thursday's auction of 30-year bonds could be a key indicator. While the 10-year auction received a boost from a concession build, the 30-year bond may not enjoy the same advantage, making it more susceptible to tail risk. However, the positive yield validation from this week's auctions so far is a significant development. As we await Thursday's ECB decision and US CPI numbers, the market's focus will be on how Lagarde describes the balance of risks around the economic outlook. The ECB's new projections, especially in light of interest rate and FX changes, could provide further insights. Our economists believe there may be slight downward revisions for growth and inflation in 2026. So, will the German two-year yield continue its downward trajectory? And what impact will this have on the broader bond market? These are questions that will keep market participants engaged as we navigate these uncertain times. What are your thoughts on this rate conundrum? Feel free to share your insights and opinions in the comments below.